Today we're going to do two sections. We're going to talk about the debt for Weyco Group, and we're going to talk about dividends. As I talked about when we did the video on operations, the company's operations are adequate but not exceptional. The reason that I'm buying the company is because I think it's undervalued. I like the dividend. I've got some money in cash that I'd rather get into this company and get a dividend. I think there's a chance it's going to go up. And all of those things make sense because the company has no debt. When the company has no debt, that means that we are not likely to go bankrupt. It means that we are not likely to, when the profits go down, we're not likely to actually lose money because we're giving money we don't have to the bank in the form of interest payments. It means when profits go up, we're more likely to return that money to the shareholders because we don't have to pay any money back to the bank. So one of the big reasons I like this company is the debt. Having said that, there's not a lot to talk about it when we look at my slides for debt because there isn't any, right? So we'll go through that very quickly and then we'll move on to dividends. So on this slide, you can see interest expense. Interest expense as a number doesn't tell you much without some kind of context. The context that I use is operating income, so I use interest expense as a percent of operating income. I think anything over 15% is disqualifying, and it'd be very hard for me to justify buying a company that paid more than 15% of its operating expense in interest. However, this company, again, is zero or close to zero and has been since 1999, and frankly, since far before that. The interest expense itself, you can see that it looks like there's a couple bubbles down there, but you know they are in the range of $1 million on a company that makes $22 million a year in profits. So they're non-issues, and probably those things were transitory debt. If the company sends a bunch of executives traveling, they've got credit card expense, right? Interest on the credit cards for the travel, and that kind of thing shows up here, but is really inconsequential to the operating of the business. So for all intents and purposes, the company has no interest expense. So here we see two numbers that are related to each other. Total current liabilities, again, just so you understand, current liabilities are monies that have to be paid back to somebody within the next 12 months. And total long-term debt is money that you owe somebody, but you don't have to pay it back within the next 12 months. So long-term debt, the company has none. Current liabilities, every company has current liabilities. They always have things they have to pay. They have the inventory that they're buying and buying typically on time. Credit cards, whatever it might be, whatever it might be for operations. One of the things that's interesting is that this company's current liabilities are dramatically dropped from, call it $70 million to call it $35 million since 2013. That's really kind of impressive. That doesn't typically happen. Although the company's profits have been relatively flat in that period of time, they've managed to cut their current liabilities significantly. So it's exceptional. Yet another reason why we like this company, despite its operations not being 5-star. Another way of looking at debt in context is to say how many years' income does it take to pay off the long-term debt? Again, this is a slide which tells us nothing other than everything's perfect because we have no debt and thus it takes no time to pay off the long-term debt, but it's one of the slides that I always look at, and I wanted you to be aware of it. So this slide is interesting. This is interest coverage ratio. So this is how many times, what is the company's ability to pay back its interest coverage ratio. And this company's interest coverage ratio is, I don't know what it is, 500, 600 times. So they have 600 times the profit in cash that they need to pay their interest because their interest is virtually nothing. So again, this slide, it looks like it kind of gyrates all over the place, but it's gyrating between several hundred times and over 1,000 times what they need to pay their interest rate. So it's more amusing than interesting. Cash equivalents, and marketable securities, it's gone up gradually over time, but again, it's not significant, gone from about 10 million to about 25 million. Kind of gyrates a little bit, but generally the trend is upwards. That's fine. I don't think they're hoarding cash. I don't think they have too much cash. I also don't think they have too little cash. So there's no reason for concern. There's also no reason to expect that there's going to be some gigantic jump in dividends or a one-time special dividend. Just kind of going to chunk along as it has for decades. Having said that, and it's interesting when you look at total current liabilities and capital leases, that's what they owe for their lease to the landlord, for the equipment leases, and for their ongoing operations. And you can see that number has gone down since 2012 pretty significantly. Meanwhile, since 2012, the amount that they have in current assets has increased significantly. So that gap is getting wider and wider. And in the last slide, I showed that it didn't look like there would be a special dividend coming, but it does. This slide looks to me like they are sort of ready to either buy some more stock or they will be increasing the dividend, which, by the way, only went up 3% last year, so it's sort of due for a bigger increase this year. So hopefully we get that, and this slide seems to imply that we might. So now on to the more interesting part of this analysis, which is looking at the company's dividends. Obviously, this chart is the kind of thing that you dream of when you're looking for, if you're a dividend investor, right? Since 2019, dividends have gone up every year. They were flat for 1 year, and there was this weird bump in, I don't know whether it was 2011, I guess, where it shot up and then shot back down in 2013. I haven't even bothered to research what that was. I'm sure it was a one-time special dividend, but I don't care because the history in the 5 or 6 years since then has been exactly what it has been. I believe this trend will continue. There's no reason to believe it won't. So if you're looking for a dividend stock, it looks like it's pretty rock solid, and it looks like they're committed to raising dividends every year. I don't think it's enough to simply look at the dividends, look at a chart of the dividends and say, okay, the company pays dividends, we should keep buying it. One of the questions is, how safe is the dividend, right? So I look at dividends in 4 categories. The first is yield and growth. We touched on that a little bit. We're going to talk about it more. Then we talk about dividend safety in the context of earnings. I talk about dividend safety in the context of cash flow. And finally, we look at dividend safety in the context of its current debt load. So the yield for this company as of the day I bought it is about 4.14%. The S&P 500 is 1.92%, so we're getting twice the market yield. We've talked about that in other slides, other videos. The dividend growth has averaged 4.4% over the last 5 years. Inflation is something less than 2%. So again, we're greatly outstripping inflation. Though to be fair, last year it was only a disappointing 3%. I expect a bigger dividend increase this year. We'll see if I'm right. So the next thing we want to look at is dividend safety in the context of earnings. So what we're saying here is a company has a certain amount of profit, and from that profit they're going to pay dividends. If they raise their dividend every year and they don't raise their profits every year, they get into big trouble. If they raise their dividends every year and their income goes up even faster than the dividends, then they start to hoard cash. So you like to see a company that's paying dividends responsibly, sustainably, and the way you do that is by, in my mind, you compare the dividends to the earnings. So in this slide, you can see the dividends per share is in red, the earnings are in green. It looks like it's pretty consistent. The current payout ratio, which is the percentage of income that's going to dividends, is about 45%. The average ratio for the last 5 years has been 49%. The average payout ratio for the S&P 500 is about 40%, but that's a little misleading because a significant number of companies in the S&P 500 pay no dividends at all, either because they didn't make money or they're in a high growth mode and they want to hoard their cash. So when a company is an established dividend payer, typically it will pay more than 40% of its earnings as dividend. So this company is in solid shape. Historically, it's in solid shape in the short term. So when we look at dividend safety in the context of earnings, we'd say these dividends are very, very safe. And again, one of the reasons I'm buying this stock is I think it's undervalued. It may take a year or two for it to get back to full value. And in the meantime, rather than have the money sitting in cash making nothing, I've got the money sitting in this stock making 4.5% and the 4.14%. And that money I'm expecting to grow as the dividends increase. So that's my strategy, but none of that works if dividends get cut. And so that's why we look at this slide and all of the slides in the dividend section. So dividend safety in the context of cash flow. The difference between earnings and cash flow is cash is a measure of money that comes in and money that goes out. Earnings is an accounting tool, and earnings can be fudged more easily than cash flow. The other thing is that cash flow, free cash flow, takes into account capital expenditures, which are typically done after we have profits. So if you have a company that is very capital intensive in the way it runs, then it can make a bunch of profits, but it has to reinvest all of those profits back in the business just to stay in business. So we like to look at that component. We do that by looking at dividend safety through the context of cash flow. So the dividend payout of free cash flow is 79.1%. That's high. The dividend payout ratio over the last 5 years is 42.8%. That's much more in line with what we'd like to see. And by the way, I only looked at the dividend payout ratio for the last 3 years. And I did that because in 2015, it looked like they didn't have a very good year. They lost a little bit of money in terms of operating cash flow, and so it kind of screwed up my numbers. It was a one-time blip. I don't see it going back when I look further and further, so I think I've chosen to ignore that. Again, this is a company that makes shoes. We're not going to see, I don't believe the American public is going to change their model or their the quantity of shoes that they're purchasing in any given 2 or 3 year span. There might be a bad year where they try not to buy shoes, but you can only do that for so long before your shoes wear out, right? So in the long run, I think that shoe purchasing is going to be pretty standardized. So again, I think that last year's dividend payout of free cash flow was a little bit high. If I saw that trend continuing, I'd be nervous, but I don't think it's going to continue. So dividend safety in the context of a current debt load. What I tend to look at here is, if a company has debt, then they have to pay interest. And if they're borrowing their money at 4%, that's probably not a problem. But if the economy was to change and interest rates went to 8 or 10 or 12%, which has happened historically in the past, then that interest payment might start to gobble up all of the profits and leave no money for dividends. And so high interest is a risk factor when you're looking at buying a company for dividends. In this case, the slide doesn't tell us much because the company has no debt. But that's really what this slide would typically be analyzing. It takes a few days from the time I decide to buy a stock to the time that I can get a video made and posted on YouTube. So if you want real-time information on my trades, if you want updates on when new videos are posted, and or you want news and thoughts on the market or stocks in our portfolio, then go ahead and follow me on Twitter. Also, please subscribe, like, and comment. It all helps as I'm trying to grow the community. Finally, if you have comments or thoughts on any of these things, I am interested. I'm not just trying to have a monologue. I'd like to have a dialogue with people. So feel free to give me your comments. I'd love to hear what you have to say. Thanks.